Seminar 2, Ratios. Ratios provide the basis of fundamental analysis. Companies can compare from year to year. They can compare to their next biggest competitor, or they can compare to the industry as a whole. One ratio provides a complete. No one ratio provides a complete picture, and that is because I could do one ratio for this in the same category, and it might be high, where high is not a good thing. But if I do another ratio, it might show that that is low. So no one ratio is going to give you the perfect picture. So you might have to do a couple out of each of these categories to get a true or more accurate idea. Now again, I'm going to compare these. I'm not going to just compare these to myself year after year. I want to compare these to my next biggest competitor, because I want to know where I stand as far as my big competitors are, and as well as my industry too. I want to know where I stand within that industry. Got to remember that when you do ratios, if I'm given a dollar amount, for instance, if I'm Nike and I do billions of dollars in revenue or sales, and if I'm Under Armour and I only do millions of dollars, it's not so much how it is, but I'm not looking at the dollar value, but I'm looking at how efficient I am. Okay, so using these ratios will tell me that. So $5 billion, it doesn't tell me anything. But when I make a ratio and I put it in a percentage, I have a better idea. Okay, I hope that kind of makes sense to you. So, and then when I compare it, I have to be able to compare that ratio to another company's ratio, because it doesn't mean anything unless I have something to compare it against. So the 5 categories of ratios, we have liquidity, activity, debt, profitability, and margin. Liquidity is the ability to satisfy its short-term obligations. Low or declining liquidity amounts is a red flag for potential issues such as bankruptcy. Cash and cash equivalents are the most liquid, where long-term assets such as equipment are not easily converted to cash. Now, usually cash equivalents are something that can be converted into cash within 3 months. Current in accounting means 1 year or less. So the current ratio is the current assets divided by current liabilities. The higher the ratio, the better. The amount of liquidity a firm needs depends on such things as the firm's size, the business volatility, and financing sources like the type of bank credit lines I might have. So liquidity ratio is the total liquid assets divided by total current debt. This represents a percent of the 1 year debt that can be covered by their liquid assets. Remember, 1 year or less is current. The quick or acid test ratio is the current liabilities minus inventory divided by current liabilities. Inventory is usually the least liquid current asset for 2 reasons. Inventory can be specific, so it's hard to sell. So if I have a very specific inventory stock, or it might be partially converted into material, it's going to be harder for me to sell that. So inventory is usually sold as a credit and then becomes an accounts receivable. This means that cash has to be collected. So use the quick ratio when a firm's inventory can be easily converted into cash. However, if the firm's inventory is liquid, use the current ratio. Activity ratio is the inventory turnover measure, which measures the liquidity of the company's inventory. Cost of goods sold divided by inventory. This tells the company how fast they are turning their inventory over, or rather how long is the product sitting on the shelf not being sold. So if I'm a company and I put a whole bunch of money in stocking up my inventory and I'm not turning it over fast enough, well, that's not a good thing, because I could be using that cash to make investments with and not tying it up all in my inventory. Okay, so did the company tie up their money by buying too much product that can't be moved out of the door? You know, that could be it. So the faster I'm turning my inventory over, the better. Or if I'm not turning over fast enough, maybe I'm buying too much. So Average collection period is the average time it takes for the company to collect accounts receivable. Calculation is accounts receivable divided by average sales per day equals accounts receivable divided by annual sales divided by 365 days. The less days, the better. That means I'm collecting my accounts receivable faster, and I want my money, right? Average payment period, the average length of time it takes for a company to make payments. That calculation is accounts payable divided by average purchases a day equals average payable divided by annual purchases divided by 365 days. So the total asset turnover determines how efficient the company is using their assets to generate sales. That's sales divided by total assets. The higher the turnover, the more efficient the company is utilizing their assets. Debt ratio indicates how efficient the company is using other people's money to generate profits. Debt ratio is total liabilities divided by total assets. The higher the ratio, the more debt or more leverage, meaning it's at a higher risk. So if I have a 75-25 ratio, meaning 75% of my is leveraged debt, I'm at a much higher risk than if I was 60% debt or 50% debt compared to 50% that I'm not that where I'm not using my debt, or I'm not leveraged rather. So times interest earned ratio measures the company's ability to pay interest. The higher the better. Earnings before interest and taxes divided by taxes. Fixed payment coverage is the ability to meet all fixed payments. Okay, so the profitability ratios. Gross profit margin measures the percentage of each sales dollar remaining after goods have been paid. Sales minus cost of goods sold divided by sales. So the operating profit margin is the percentage of each dollar remaining after all costs and expenses except for taxes and preferred stock dividends. Operating profits divided by sales, that's the net profit margin, is the percentage of each dollar remaining after all costs and expenses, including taxes and preferred stock dividends. The higher the better. So that's earnings available for common stockholders divided by sales. Earnings per share, dollars earned during the period of each outstanding common share. Earnings available for common stockholders divided by number of common shares outstanding. We're only discussing earnings per share is only for the common stockholder, common stock shares outstanding. So if you have preferred stock in your calculation, you have to remove that. So return on total assets, or ROA, or return on investments, ROI, measures the effectiveness of generating profits with assets. The higher, the better. Earnings available for common stockholders divided by total assets. Return on common equity measures return earned on common shareholders' investment. That's earnings available for common shareholders divided by common stock equity. Our market ratio measures the amount the investors are willing to pay for each dollar earned. So a market price per common share divided by earnings per share. Market book ratio is how investors view the firm's performance. So there's two parts to this. And the first part is you have to determine the book value first. So the book value is the common stock equity divided by number of common shares outstanding. The market price per share of common stock divided by the book value per share. The amount is compared to $1. So for example, if the ratio was $1.50, this means that the investors are willing to pay $1.50 per share for every $1 of book value of the stock. So here's your assessment question 2. List and explain one ratio from each of the 5 categories discussed. Provide an example that includes a calculation. You can make up your own calculation, but in your example, I want you to explain what the category, and then I want you to tell me in words what the calculation is, and then I want you to tell me with numbers what it is. Okay? All right, so inflows and outflows of cash. The statement of cash flow summarizes the inflows and outflows of cash during a given period. A decrease in cash flows is an inflow of cash because when cash that has been tied up in an asset is released and can be used for some other purpose. An increase in cash flow represents an outflow of cash because additional cash is being tied up in the cash balance. This is kind of a difficult, not difficult, it just takes a little bit of thinking to get used to this, the way cash flows. So I outlined it for you right here. So inflows and outflows of cash. So inflows is a decrease in any asset, increase in a liability, net profit after taxes, depreciation of other non-cash items, and sale of stock. An outflow is an increase in an asset, a decrease in any asset, a net loss, dividends paid, and repurchase or retirement of stock. Operating cash flows, or OCF, is cash flows generated from normal operations, selling and producing its output of goods and services. That would be considered normal operations. The net operating profits after taxes, or NOPAT, is calculated as EBIT, which is earnings before interest and taxes, 1 minus T, which would be the tax rate. So I've got an example in here. So converting NOPAT to OCF, so is NOPAT plus depreciation, or EBIT times 1 minus T plus depreciation. So here it is in numbers. So we got 250 times our tax rate of 1 minus 0.35, we'll say 35% tax rate, plus our $50 depreciation. So we have $162.50 plus our depreciation of $50, and we come up with $212.50. So our free cash flows, or FCF, represents the cash available to investors after the firm has met all operating needs and paid for investments in net fixed assets and net current assets. So FCF, or free cash flows, is OCF, operating cash flows, minus net fixed asset investments, NFAI, minus net current asset investment, NCAI. NFAI is the change in net fixed assets plus depreciation. And there's a good example, I didn't put it in the PowerPoint because it was pretty lengthy, but there's a very good example on page 122. It's pretty good, so you can go observe. Okay, so the time value of money. Time value of money. It is better to receive money sooner than later because the money you receive today can be invested to make a positive investment in the future. All right? So a single amount is a lump sum amount held or expected in the future. So if I receive $50 today and $40 to be received at the end of the next year, that's a single amount. So annuity is a level periodic stream of cash flow. So I'm receiving or paying $50 at the end of each year for the next 5 years. $50 each year. It doesn't differ. A mixed stream is an unequal sum or an unequal stream of cash flows with no particular period. That would be year 1, I paid $50, or I received $50. Year 3 is 30. Year 4 is 20. There's no pattern whatsoever. So future value of a single amount. The value of money in the future, if deposited today and earning interest, applies compound interest over a specified period of time. Present value of a single amount is the current dollar value of the future amount. The amount of money invested today at a specified rate to equal the future value. This is often referred to as discounting cash flows. So an ordinary annuity is annuity where the cash flow occurs at the end of the period, and annuity due is annuity where the cash flow occurs at the beginning of the period. The value of annuity due is always greater than the value of an identical ordinary annuity because the cash flow of the annuity due is at the beginning of the period rather than at the end. This means that the money is received sooner, so the future value is greater. All right, so here on Excel, I know your book has some financial calculator examples, but Excel is fairly simple to use, and I use this all the time. So where I work during the I'm an accountant, and I work with a lot in finance almost every bit as much, so I have to use Excel a lot. So on the FX, and I hope you're all familiar with Excel, and if you're not and you really can't get through this exercise, please give me a call and I'll walk you through it. I wish I could do a WebEx with you, but I could not get that to work in my in our national our school website. So, but I will walk you through this. And remember, I have office hours on Wednesday, and we can do a chat on it as well. I always open a chat room for our office hours. So anyway, on the FX, it says FX at the little bar on. I got a picture of it on the next page, and let me see. Let me just flip. Go to the next bar. I took a picture of it, and the FX is right here. And all you're going to do is, I'm going to go back here.